From the financial centers of the world, this is Bloomberg Markets with Alix Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Friday, September 22nd. Here are the top market stories that we're following for you at this hour. Party like it's 2007? You got long-term bond yields hitting a 16-year high overnight. And now take a break while the S&P pretty much goes nowhere after the recent slide. And measuring PMI pain. U.S. holds up. Euro area UK PMIs pretty bad. We're going to get instant analysis with Chris Williamson of S&P Global Market Intelligence. And auto strikes rev up. UAW could expand its walkout today after a week of no agreement. We're going to get you the latest. From New York, I'm Alix Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, it does feel that everybody's tired. And I'm not talking my book. I'm just saying everyone feels tired. Volume's really light. It just feels like everyone's taking a break.
I'm not sure everybody's partying right now with these higher yields. It feels like it's maybe the punch bowl being taken away. That's going to be the problem. That's going to be the impact that maybe these higher yields ultimately have on the economy. Susan Collins of the Fed giving some further comments on what is happening here. Further Fed hikes are certainly, quote, not off the table, according to her. The PMI data, I think, paints a really interesting picture today, Alex. Certainly a fairly bleak one for Europe. They have been pointing to a fairly bleak picture for a while, but the numbers just continue to get worse. In the States, less so.
Yeah.
So our question of the day is basically around how much pain do they point to? And it feels like the answer is very different depending on which side of the Atlantic you're on or which side of the Pacific you're on, for that matter. So let's get some instant analysis. Chris Williamson, S&P Global Markets Intelligence Chief Business Economist, joins us to discuss this. If I'm Alix Steele over in America, the picture looks much better. If I'm Guy Johnson here in Europe, it doesn't look quite so clever. Chris, give me the instant analysis and how different that analysis is depending on where you are.
Yeah, it's an interesting way of looking at it, Guy. Certainly the European numbers, both Eurozone and UK, turning down in recent months. Some signs of maybe it bottoming out in the Eurozone, but forward-looking indicators like order books, they're still turning down really quite sharply. So more pain to come. So the upshot is you're looking at signals of Q3 GDP declines, both for the UK and the Eurozone, with that weakness persisting into the fourth quarter. US, on the other hand, is fairly stable at a pretty miserable level, mind you. We're pretty much stalled. So we had a good growth spurt up to July, really, which seems to be fading now. So you might get a good GDP reading for Q3 in the US, but I think Q4 is going to look quite different. So there's just a delaying the pain, really.
That was some cool focusing that just happened on your camera. Chris, delayed pain, does that mean that we're going to see U.S. PMIs roll over to the extent that we've seen in Europe and the UK, or will the U.S. always, in some ways, outperform?
I think the US will outperform. We've had, obviously, big drags in Germany from the energy price hike. We're seeing that in manufacturing. One of the reasons why the German manufacturing numbers are just so weak. There's been a structural hit, if you like, to the German factory sector, which it's still reeling from. And the US, in contrast, is investing a lot of money in expanding new production facilities with the new acts that Biden's brought in. So I think the prospects for manufacturing in the US are looking a lot brighter than in Europe at the moment. That's a big factor to help. The other side of the whole economy, of course, is the services side, where we're seeing this synchronized weakening of growth from consumers being hit by the increased cost of living and higher interest rates in the US and Europe. That's really beginning to take a toll now. So it's going to be a key thing to watch as we go forward, just how much households are being hit by that element of that headwind.
Chris, the Bank of England apparently saw your data before it made its decision relating to pausing its rate hiking cycle. What within that data do you think would have caused them to pause?
Well, for a start, the weakness of the activity levels, then that's also translating into a sudden, quite worrying downturn in hiring. The job market, as we all know, has been fairly resilient, and that's helped keep this wage growth up. But one of the things central banks are looking for is the labour markets to start weakening and to start reducing that wage bargaining power. And that's exactly what you had in September with those PMI numbers. That's coming through really quite clearly now. But then the other side of it was a sharp reduction in price pressures as well. So although we had higher prices for energy, notably from the oil price hike. That doesn't seem to have cut through. There's other forces at play here, and this reduction in pricing power firms have got. So their costs may be rising, but they just can't pass it on.
And this also goes to maybe the employment part as well, because what I thought was interesting was in the U.S., you're still seeing employment growth, not quickening, versus in the U.K., for example, or Europe, where it's not. Walk me through the why there.
Yeah, well, this is about labor market supply, first and foremost. So yeah, job growth actually picked up in the US. Now, you've got more people starting to struggle with the cost of living and interest rates, and they're coming back into the labor market, which means some of these long-standing vacancies can be filled now. So this is helping support those numbers in the US. The question, of course, is how long will this persist for? Even in the US, we've got backlogs of work falling sharply now. Companies are going to start looking at their workforce numbers soon if that persists.
Chris, what is the message on inflation?
The inflation, it's stickiness, stubbornness, around the 3% mark. It's not faltering yet. Again, let's watch those labour market numbers. That could help bring it down. Against that, you've got the oil price rise. The overall picture is sort of stuck at 3%. This last leg down to 2% is still looking really unattainable.
Chris, always great to catch up. Thank you for the instant analysis. Chris Williamson, S&P Global Market Intelligence Chief Business Economist with the PMI data. Let's turn our attention to another event that is happening right now. We're expecting it to happen right now. We can't see that it's started yet. The UAW President Sean Fain, we understand any minute now, will hold a Facebook Live event. He's going to be updating on the negotiations with the automakers and potentially updating us on where the strikes are going to progress to next. People familiar with the matter apparently saying that the UAW is making, quote, meaningful progress with Ford. Where does that leave everybody else? What are we expecting over the next few minutes? Craig Trudell joins us now. This is his wheelhouse. You're behind the driving wheel of all our coverage here on autos. It hasn't started yet. We understand Ford is making progress. What are we expecting to hear?
Yeah, importantly, that language around substantial progress was the sort of bar that the UAW said just a few days ago was what these companies were going to have to clear or else the strike expands. And so I think, we have not been able to confirm this just yet, but the expectation is that Ford may be, kept at just one factory for the time being. With GM and Stellantis, it may be another story. We have not gotten an indication that substantial progress has been made. With each of those companies, it's just one factory that's been down for about a week, as has been the case with Ford. The expectation there would be that we would see some additional plants struck as a result of that lack of progress.
So it looks like the Facebook announcement with Sean Fain is indeed starting. Craig, if we do see progress with Ford, don't the others kind of have to go along? It's going to be hard to make a deal with one and not the others around the same kind of terms, right?
Ideally, we'll see some, I guess ideally if you're a car maker in Detroit right now, we'll see some semblance of normalcy restored here because this is how it has always worked in the past. You've had the union sort of, settle in with one car maker, hammer out a deal, and then try to use that deal to sort of leverage agreements with the other two. And even if it's one at a time, or at the same time, in the past, that's the way this has gone. I think the very unique aspect that we've seen here is the UAW sort of rip up that playbook. The UAW president, Sean Fain, has actually, thrown offers in the trash in a sort of show of his frustration with the offers that have come in from these companies. And that's not the only way that he's sort of thrown out convention in the way that he's approached negotiations with these companies.
It looks like some sort of video is playing. As soon as we get to Sean Fain, we will bring you the news on what he is going to tell us about where we progress from here. What is if the strike is going to progress, where is it expected to progress to?
That's one of the sort of uncomfortable facts for these companies is they don't know what the union's next move is.
Yep.
I think, generally the expectation, if I were a betting man, would be assembly plants because parts plants are unlikely to be a sort of good place to take those out because that will lead to other assembly plants going down and potentially lead to layoffs that the UAW would have to sort out, strike funds going to those plants anyway.
All right, Craig, thanks a lot. Super appreciate it. We're going to bring you back further if we have more updates. Coming up, we're going to get to our question of the day, but I do want to take you now to the UAW Auto Workers President Shawn Fain. He's speaking on Facebook. Here's kind of what he's talking about.
Region 1, 400 workers at Lear, the auto parts supplier, just joined Local 155. President William Verdier and Recording Secretary Sylvanus Thomas worked hard to help bring these workers into our union. From auto to higher ed and everywhere in between, our union is organizing, growing, and building our power. It's not just new organizing, it's on the picket line too. Our 1,400 UAW members at Blue Cross Blue Shield of Michigan just marked a week on strike. For years, the insurer has been outsourcing their work. Our UAW family at Blue Cross Blue Shield was once 5,000 strong. Today it's shrunk down to just 1,400. And the workers that are left are stuck in a tiered system where it takes 22 years to get to top pay. Our members have said enough is enough, and they are being strongly supported by Secretary-Treasurer Margaret Mock, Region 1A Director LaShawn English, and Region 1D Director Steve Dawes. They are all working together to raise awareness and build public support for this critical fight.
This economy has held up too well to pile into defensive parts of the market. So we want to be really particular in what we're looking at if we do expect a broadening of market participation. And this is really for the quarters ahead as we head towards 2024.
That was Mona Mahajan, Senior Investment Strategist at Edward Jones, speaking earlier on Bloomberg Television. So it leads us to the question of the day. How much pain are the PMIs predicting? They tell different stories, varying degrees of pain in the UK, Europe, as well as the US. And then how is that reflected in the markets? Kathy Entwistle, Morgan Stanley Managing Director, joins us now. Kathy, how much pain are the PMIs predicting and where?
Yeah, every time we see the PMIs go down further, it's just showing us that there's going to be more issues that are coming and that we need to be concerned. So a lot of times these numbers that we're looking at across the board when we're looking at the economy, we're trying to figure out where we're going. And again, these will help us realize that the reality is there are issues in the markets, there are issues in the economy. And even though we've been seeing such a great trajectory of growth stocks in the markets, overall, there's issues to come and we have to think about them and know that we need to position ourselves properly to manage our portfolios against that.
Kathy, the big story out of this week has been central banks that have paused. We've had PMIs that are pointing to slow down or at least sort of not stagflation, but stagnation at best. Yet you look at what is happening in the bond market and the yields that we're seeing and the climb that we've seen in yields this week, and it doesn't all add up. How do you put all that on the same piece of paper and make it kind of connect?
Yeah, that's interesting. It's almost like a tale of two cities. We're looking at inflation, and there's some inflation that's coming down and some inflation that's going up. We're looking at, the PMI numbers, and we're looking at the services that are, underlying that. And it really is very typical of where we are in the, the cycle. We're sort of in the late cycle of this market. And we should see some relief eventually, but we're not going to see it yet. And I think as long as you're aware of that and you look at opportunities to take advantage of, I guess, low points and buy at those times, that's how you manage your way through the market in terms of spending and the reality of that we're all consumers and how are we going to get past these high costs and high prices and will people still pay to travel and things like that. I think we're going to see some pain there.
Well, okay, so as an equity investor, let's just say, take the equity market, for instance, because what I found so interesting about the PMIs and then the reaction in the equity market was the lack of. Like, sure, we're a little heavy over in Europe. Sure, we're holding up okay here in the US, but like no real movement, right? So I'm just wondering, like, is all the bad news already priced into Europe to some extent, but it's the US that has more to go?
That's a great question, Alex. And I would say that when we look at the markets and where the opportunities are, we think Europe does have a little bit more advantage because the valuations are lower and there's probably more opportunities there where, yes, the US probably has more to go. And as we all know, the way the market has been running, it's really been based on just a few key stocks. And there's a lot of underlying stocks that are not performing quite as well. And those also might be the stocks that are the opportunities for clients going forward.
Why would I want to come out of cash, though, right now, Kathy? As you say, we're at a really difficult juncture. We're trying to read the market. It's a struggle to read the market. This week, bonds have gone down, stocks have gone down. What do you do with that? Do you just sit in cash, wait, watch, see what happens, and then make a decision when the chips are kind of easier to read? How do I play this?
That's a great question. It's tempting to stay in cash because you are getting that 5% return, which seems a lot more positive than some of the markets that we're seeing with bonds and stocks, especially in the last week. However, we have to think long term. We have to have more of a disciplined approach. So we don't want clients to be out of the market. We want them to be in the market, but more focusing on the areas where there might be more opportunities, more defensive type companies. And also, when you think about growth stocks, look at growth stocks at a reasonable price. Look and make sure the valuations are reasonable. And you can also look at dividend paying stocks, but also look at dividend paying stocks that are growing their dividends, because that's showing that they have some opportunity to increase the value of their company as well. So looking in those areas are a little bit, I guess, smarter right now than others.
So Kathy,
dollar cost average too. Sorry, Alex.
Yeah, no worries. Dollar cost average, you gotta love that one. But that seems to me like buy consumer staples and buy AI tech stocks on the dip. Is that a fair assessment?
Yeah, you know, healthcare, financials, energy, and buying the markets on the dip for sure.
Yeah, but in terms of my risk tolerance, am I being risk averse right now? Am I in defensive mode? Am I in wealth preservation mode right now, Kathy, rather than trying to make money?
Yeah, you should be in defensive mode. First of all, you want to protect the money that you have. You want to protect your investments. So you want to be in areas that are more defensive, and you don't want to be overly aggressive. Interestingly enough, we're finding that, you know, maybe 10 years ago, we would have clients in portfolios that were the old, you know, 60-40, 60% equities, 40% fixed income / cash-like investments. And we're actually bringing down that allocation to equities, not expecting more than, we're not expecting more than high single-digit returns over the next 10 years in the equity markets. It's not going to be like 2011 to 2021. So you have to be thoughtful and you have to be selective about where you're putting your money.
Kathy, great to catch up. Have a great weekend. Really appreciate the time as ever. Thank you very much. Kathy Entwistle, Morgan Stanley Managing Director. The Sean Fain event is still ongoing. He continues to update and brief as to where the UAW is going to be moving next. He talks about the fact that GM and Stellantis still need a serious push. He talks about the fact that there has been progress with Ford. It looks like they're making the most progress with Ford. So this is what's going to happen. The UAW is going to expand its strike action against GM and Stellantis. It is not going to do so against Ford. It feels it needs to push Ford a little harder, but progress is being made there. Clearly, it feels it needs to push GM and Stellantis much harder, and as a result of which, the strikes will be expanded. We'll continue to follow this event for you. This is the Facebook Live event that is taking place right now, and we will continue to keep you abreast of what Sean Fain is saying and the implications for the auto industry and the US economy. Still ahead, we need to talk about what is happening in the tech sector. Microsoft, Activision, that deal could actually happen. The deal edging closer in the United Kingdom. This as UK regulators signaled they will accept Microsoft's latest, quite substantial concessions. Details of that next. The startup is coming. This is Bloomberg. Alex, we probably need to go back and check in on what is happening with the UAW update. Sean Fain updating us now on what is going to happen next. We are going to see a significant expansion of the strike. The strike is going to be expanded to 38 locations in 20 states. This is at GM and Stellantis facilities. Ford, where progress appears to be being made, we're not there yet, but Ford is going to be spared that expansion.
Yep, and you can really see it also in the stock price. Ford is holding up okay. That stock up by about 3%. GM kind of rolling over here at neutral. Stellantis, though, still holding up by 0.6%, but off its highs. But very clear, like we're not done yet. but definitely obviously making the agreement that as they inch forward, that things can go the car maker's way as well. If they give a little, then they get less strikes, I guess. But Stellantis and GM, definitely not done yet. I do wonder, though, Guy, if they do, as I mentioned before, if you do make a deal with Ford, is that just going to be the deal for the other car companies? Is there a first mover advantage when it comes to making a deal with the union?
Probably, yes. Ford has traditionally had better relations with the UAW, so that may be kind of the easier part of the narrative. Maybe the others are going to hold things up. They are going to fight a little bit harder. So maybe they don't just take the Ford deal and say, that's what we're going to do as well. Maybe they're actually going to say, you know what, we're going to take a different view. We're going to take a different stance on this. As I say, better relations with Ford traditionally with the UAW. Let's talk a little bit about what is happening as well with the Microsoft and Activision deal, because you're certainly seeing an impact in share prices around that. Probably time to take you to the startup. Ed Ludlow covering this story for us. Ed, let's talk about the deal that looks like it's going to be done in the UK that may get this deal over the line. So the UK regulatory authorities had held this deal up, but there's been a big concession. Does this kind of show that maybe the UK authorities were right to push a little bit harder?
It's so funny to say a big concession, because the point the CMA made, and Sarah Cadell on the show earlier, right, was like, why didn't you guys just make this offer at the beginning? If you'd done it at the start, you wouldn't have incurred the costs of negotiating that you had. But the compromise is to sell cloud gaming rights to Ubisoft, a French independent studio game developer or studio, and that has satisfied the regulator. And you know, I can tell you that both Microsoft and Activision were very frustrated that cloud gaming was even the point of contention, because it's such a nascent and small market. But some strong words from the CMA on Bloomberg Television earlier. It was interesting. Yeah,
I have to wonder, are there other deals that could now come to the foreground if they do a little bit of negotiating here now?
What's so funny about this deal is Microsoft bought Activision for mobile gaming and the metaverse, right? That is what King Studio at Activision is good for. The getting hung up on the cloud kind of really had nothing to do with Microsoft or Activision's motivations. But again, the political context here is so interesting. This is post-Brexit CMA, right? Go to the Bloomberg story and look at what the CMA chief said to us earlier. And it's basically like, this is a lesson learned for anyone that wants to do a big deal, that wants to avoid an expensive negotiation, come to us with the compromise that we asked for up front. It's pretty fighting talk, I don't know.
It is, it's interesting, and it looks like finally this deal may get done. Ubisoft, one of the big beneficiaries, certainly over here in terms of the share price reaction, could be one of the big winners out of this deal. Ed, I'm sure you're going to have some great coverage on this a little bit later on. Bloomberg Technology coming up in around 90 minutes' time. He will. Ed and Caroline, Bloomberg Technology a little later on. Sean Fain has just finished. We'll continue to keep you updated on that story next regarding the UAW. This is Bloomberg.
We're about an hour into U.S. trading session. I gotta say, volume is really light. It does really feel like everyone's exhausted from this week, and we're just taking a bit of a breather. Abigail's tracking the moves. Abby?
Yeah, real Friday feel. And this is a classic board that we would have taken a look at back in the day, led by the Dow. But you can see the Dow up the least, up 0.1%. The S&P 500 up a bit more. And then tech, the NASDAQ 100 up about 0.6%. So a little bit of a relief pop after 3 down days in a row on the hawkish pause from the Fed, or higher for longer. The idea that the system could be taken, some more money could be taken out. On the week, it's a different story. This is really, again, it's not even a relief rally, it's a relief pop. It'll be interesting to see if it lasts on the whole day. Here is the S&P 500 this week, down about 2.4%. Last time I looked, this was the worst week going back to early March, down for a third week in a row. So the selling that we started to see back in early July, or excuse me, late July, right after the last Fed meeting, when they also delivered what seemed to be some sort of a more hawkish tone than what markets had expected. I think that they've been pretty transparent in this, but markets keep getting caught off sides. And that is, of course, resulting in yields trading higher. Take a look at the 2-year yield, up 5 basis points, but more importantly, the level up 5.08% earlier, closer to 5.15, then the 5-year at 4.55. That 10-year yield right now at 4.4% or so. Likely, I think it had touched 4.5%. Again, technically, we've been talking about the fact that now that it's breached above resistance, you could see an equal and opposite move back above 5%. Then the 10-year yield is the big loser on the week at a 4.53. But it's kind of amazing that you could have the 30-year trading below the 2-year. I mean, it's just really kind of crazy. In any case, if we take a look at the S&P 500 pricing all of this in, we've been watching this chart for a while. These lines, these fan lines show that last year's bear trend, bear market was reversing. Here's the range. For a little while, we popped out. It gave us some hope. This week, take a look at this. This is how bearish this week is. We are now close to the bottom of that range. The RSI on a weekly basis is moving lower. Guy, Alix, actually, this suggests that we are going to see this S&P 500 go, I would say, somewhere to 42.50, but the bigger thing is, does this range, this ascending range, does it break to the downside? It is a bearish pattern. So again, this fall may prove interesting.
Yeah, and sort of what that catalyst is even going to look like. Abigail, thank you so much. Really appreciate it. So one catalyst could be oil. So oil prices trading around $94 a barrel, capping a very tumultuous week. The highlight was Russia banning some product exports, which is really going to tighten up that market. Christian Malik is JP Morgan Securities Head of Global Energy Strategy. He joined Bloomberg TV earlier today.
The question we've had a lot today is why 100? Well, when you look at spare capacity of OPEC, over the next few years, the only ones that are going to be able to fill that gap in supply is OPEC. And historically, when spare capacity has fallen to sort of between 5 and 10% of total capacity in the world, that's a risk premium, which I haven't used that term for a very long time in oil, maybe last year briefly, that will drive $20 above the 80 to 100.
So that's the strategy take. Why don't we get the investor take? Ben Dell is Kimbridge Energy co-founder and managing partner. Kimbridge is an alternative asset manager focused exclusively on the energy sector. And Ben, by energy, I mean everything. You recently closed your latest E&P fund, so you do have oil and gas. You also do a lot of climate-related stuff as well, and you're working on some carbon management exchange things. So we're going to get to all of that. Do we get to $100 oil?
I think we do. I don't know if it's 2024.
Stay there?
I think we're going above 100. I mean, fundamentally, what we're seeing here is a repeat of the 2000s in the sense that the upstream business is consolidating. Operators are not investing in supply. There's an underinvestment on the supply side of the equation. And ultimately, we're going to see the marginal cost of supply rise. And I think that'll continue to drive up commodity prices, both oil and gas prices, over the next 2, 3, 4 years.
How does the Permian react to that, Ben? If you see prices north of 100, the temptation to crack is going to be enormous. Now, the privateers will definitely do that, but what about some of the bigger companies as well?
I think you're going to continue to see discipline. I mean, 5 years ago, we saw the business model of the upstream oil and gas companies change from a high growth, no return model to a low growth, high return, distribute cash flow, improve balance sheets. I think the other thing that we've been seeing happening is a ramp up in M&A. And we saw this in the 2000s. We saw large cap buy small cap. The large cap operators are short inventory. And as a result, they're starting to accumulate and aggregate smaller companies. It started in the private space. We're now seeing it in the public space. Again, we saw that in the 2000s. And as we lower the number of companies operating in the space, I think you'll continue to see discipline associated with that.
So, yeah, I mean, we've seen actually the private play, I mean, we've seen production kind of static. Do you think that's because the private players have come to religion here and are trying now to clean themselves up to then do some M&A with some larger guys? And are you into that?
I think it's fundamentally a change in the business model driven by an understanding that delivering return on capital employed and returning cash to shareholders is what shareholders care about right now. The second issue is there's a lack of capital in the space. If you look at private equity fundraising, the last 2 years have probably been the worst on record in probably 20 years. So there's really no capital to put to work from a private side. The cost of capital has gone up on a debt side. And when you look at the compression in multiples, the cost of capital on the public side has gone up. So I don't see that changing anytime soon. I mean, fundamentally, we've seen that capital move away from the space. I think if returns stay elevated, multiples ultimately expand, money comes back, and then we grow the supply base again. But that may be 4 or 5 years away.
Which 4 or 5 years we're supposed to be doing a net zero thing and like working towards that. So somebody mentioned to me the other day that what's happening in the alternative energy space in terms of, say, a capital suck is what we saw in shale back in 2015, 2016. We learned that the returns are a lot less. You have to plow in a ton of more money to even eke out those small returns, and we're kind of readjusting for that. Is that true? I mean, and if so, like, how do you, Bendel, invest in that space?
Yeah, I think there's a lot of analogs. I mean, if you look at renewable power, especially solar and wind, it's all been about megawatt growth, and it's not been about returns. And the argument you've heard is we're going to grow, we're going to get bigger, this space is going to accelerate. And I think what we've seen is a number of people make investments where the returns on those are low single digits. Now we have a higher cost of capital, and we're starting to see those companies' multiples compress because investors are realizing there's actually no value creation in that opportunity. I think what you'll see in the renewable space is what you saw in the shales in 2010 to 2020, which is that growth will decelerate, companies will consolidate, and the smaller cap players will get acquired. And we'll see better capital discipline, and ultimately those business models will also change. So I think it will come, but I do think you're seeing the parallels of the shale revolution in renewables right now, which is its growth at any cost.
Ben, one of the issues that we continue to have with the energy transition is we don't have a lot of frameworks in which we can operate. We don't know what the price of carbon is. We don't know what the price of anything is, to be honest, going forward from here. When is that problem going to be solved? Do we just adopt EU carbon trading? How do we fix the problem of commonality of the baseline from which the industry is going to grow?
Yeah, well, what we've said is that really everybody wants the same thing, which is low-cost power on demand with no carbon footprint. And if you look at that, you have your existing asset base, oil and gas, and you have carbon removal. And on the other side, you have renewable power, and then you're going to need to pair that with storage. And in the long run, what we should see is the price of carbon go to a marginal cost of renewables plus storage. Now, I think there's a huge path, decades long, of price discovery in that. We personally would love to see a carbon price. We think carbon markets are critical to success. And the reason I say that is what we've seen in the IRA is that if you create economic incentives, capital will follow. And when you really think about what a fully functioning carbon market will do, is it puts a price on the emission, and it will bring capital to lower those emissions.
Right, because if you can't price it, then you can't invest in it. So unless you can show an investor, I'm losing this much money because of this carbon, I have to invest in it, it's not going to happen. So, but everyone wants to create a verified trading carbon platform. Like, everyone wants to create the holy grail of, like, I'm going to judge this tree versus this carbon management capture over here. You're also doing that. Is there room for all the players? How does this wind up if you're not all on the same platform?
There is. I think, listen, the carbon market will grow over time. We've seen it internationally. I think it will happen domestically. The fundamental problem with the carbon market right now, though, is transparency. If you think about carbon removal, what we care about is additionality. Have we taken carbon dioxide out of the atmosphere? And duration, are we doing it in perpetuity? When you think about that, it's really a mass balance. Whether someone looks at a tree or a new tree, whether someone looks at storing carbon underground, you should be able to measure and verify that you have stored the carbon and it's there in perpetuity. We're big fans of carbon removal credits. I think the market has got somewhat mired in this discussion about avoidance, which are counterfactual arguments about, well, this forest would have been cut down if I didn't do that.
Right.
And we need to see segregation between those two. We need to see greater transparency. And I think at that point, you'll see an acceleration in the market.
Before we let you go, LNG, you have an agreement with Commonwealth LNG. Any update there? Like, how big are you betting into the LNG U.S. export market right now?
We believe that fundamentally one of the best ways to remove emissions is to convert coal to natural gas. That substitution has been one of the biggest drivers in the US, and the US has the ability to export gas into international markets and accelerate that adoption internationally. We have an upstream asset in South Texas. We're integrating it through to LNG, and we believe we can actually put LNG on the water with no net emissions on a Scope 1 and Scope 2 basis. So we're big believers in the growth of US LNG. Well, we'll hopefully be doing that by 2028.
Okay, that'd be huge. Like, green natural gas in just a few years is like that, no longer a bridge. Like, that's gonna be the real fuel going in. Ben, really cool stuff. Thank you for joining us, Bendel of Kimbridge Energy. And next week, speaking of energy, I will be at the 2023 American Energy Security Summit in Oklahoma, where I'll be talking to the heads of Oxy, Devon, and Continental, plus a conversation with Nikki Haley, the former U.S. ambassador to the U.S. No, Guy, I am not bringing the hat.
Sorry. Okay. If you're gonna answer the question already, we could have some fun with that. But if you're ruling the hat out already, that's a huge shame.
It just takes up a lot of space on the plane. Okay, ETF Friday is next. This is Bloomberg. It's been a week, so let's get to ETF Friday because there's been one that has a very big uptick in volume recently, almost fully recouping losses from earlier in the year. And Emily Grafeo joins us now for today's ETF Friday to tell us which one it is. All right, what is it?
So this is the Dynamic Beta Managed Futures ETF. The ticker is DBMF, and it seeks to replicate the hedge fund strategy of managed futures. This is a quant-based strategy, so no discretionary investor involved. They're going long and short various asset classes and commodities. And this strategy really fell off in the beginning of the year as the stock market rallied. Now we're seeing volume pick up, and DBMF had its biggest inflow ever last week, $96 million in one day. The idea here is that as stock and bonds pick up in correlation, maybe investors are going to want an alternative asset class, and you can get that with managed futures. At least that's the promise of DBMF.
Emily, just very briefly, who's buying this?
Well, it's unclear with ETF inflows, exactly where it's coming from. Retail investors obviously can buy ETFs, or you can have professional asset allocators who have a 60-40, but they want a little slice of an alternative, and they can add that managed futures allocation in there.
Emily, great stuff. Thank you very much indeed. Emily Grafeo joining us for ETF Friday. Coming up, we are going to be speaking to the Greek Prime Minister. Kyriakos Mitsotakis is going to be joining us. That conversation next. This is Bloomberg. So, let's talk about Greece. More than a decade after we saw those bailouts and those horrible austerity measures, Greece has been pulled from the brink of bankruptcy and the country very much economically on the rebound. In fact, to the point at which it's on the cusp of regaining a series of investment-grade ratings. Here to talk about the economic outlook for the country in light of rising interest rates, what's happening with the slowdown that we're seeing, certainly evidenced by today's PMI data at the core of Europe, is the Greek Prime Minister. He is, of course, Kyriakos Mitsotakis. Prime Minister, thank you very much indeed for your time. I hope you're having a great week in New York, and it's fantastic that you can take some time to join us here at Bloomberg.
Well, thank you.
We are starting to see an economic slowdown in Europe. We are starting to see Germany slowing down. We're seeing France slowing down. How do you think that's going to ripple into your economy?
Well, first of all, I'm happy to report that the Greek economy has proven particularly resilient. We will have significant growth rates for 2023. I expect growth in excess of 2%. And my goal has always been to significantly exceed the Eurozone growth, average growth. And I think this is a success, taking into consideration everything that had happened to Greece over the past decades. So I think Greece is back for good. We just won our second mandate. We have a very clear reform agenda. We just got to investment grade, which was an important milestone for the country after 13 very difficult years. And if you look at all the indicators, I think we will do significantly better than the Eurozone average. And I'm cautiously optimistic that we can maintain this growth track for the long term.
So what's your goal then economically for 2024 in light of potential 4% interest rates from the ECB for longer?
Well, first of all, the fact that we got to investment grade, helps us with our borrowing costs, and this is, of course, significant for public finances. But we've also been unapologetic about maintaining fiscal discipline. We understand how important this is for global capital markets. Looking at Greece, we will have a primary surplus of 0.7% this year, and a higher primary surplus in 2024. And we feel that we can meet these fiscal targets without compromising our growth. If you look at tourism numbers, they were remarkable this year, and there seems to be a trend in Europe. In spite of the recession, people continue to travel, and they seem to continue to prefer Greece over maybe other Mediterranean destinations. And of
Guy
course,
definitely does, by the way.
Well, you should, Alex, you should too.
Right, Guy?
And Greece is a lovely country to visit, and not just during the very hot months of July and August. We've been able to expand our tourism season and attract significant investment in sustainable tourism.
Okay, actually, Prime Minister, I'd like to talk to you about that. I managed to avoid it this year, but I know plenty of people that didn't. It got very hot in Greece. It got very hot around the Mediterranean this year. I talk to people in Scandinavia, and they think that they are going to be the big beneficiaries of this. They think that people will no longer want to travel to places like Greece if it's 45 degrees and there are fires burning? What do you think the long-term trajectory is for Greek tourism if we are going to see this climate change sticking?
Well, I disagree with this hypothesis. People still enjoy the hot Mediterranean, and they do want to come to the Mediterranean and to Greece in particular during the summer because they like to spend time at the beach. If anything, I would argue that climate change is an opportunity for us to expand our tourism season. Yes, it may be hot to come to Greece in July and August, but we will always have enough people interested to come to Greece during those 2 months. But we have now more people interested in coming to Greece in March and April, or October and November, more people interested to come to visit our cities year-round, and expanding our tourism season has always been an important priority for us. And I think, Guy, that there will be more people who, given the choice, will choose not to take their holidays in July or August, not just because it may be too hot, but because it's too crowded. So for us, it's a great opportunity to expand our tourism season and also to open new destinations on the mainland for people to explore. So it's still going to be some time until the Scandinavian beaches or the Danish or Swedish beaches are going to compete with the Greek beaches. I don't see this happening anytime soon.
I'll pass that message on next time I see them. You did face some criticism, though, in the way that you handled the wildfires this year. What lessons do you think you learned?
Look, I mean, the climate crisis is here, and it's here for good. We've always had wildfires in the Mediterranean, but we had particularly intense wildfires this year, and we also had unprecedented floods. So it's very clear that we need to focus more on short-term adaptation. And this is, of course, a case I'm also making to my European colleagues. We spend trillions of euros on long-term mitigation, and rightly so, because we want to be leaders in the climate transition. But we also need to support people when they lose their livelihoods, their houses, as a result of climate disasters today. So we need to be much more effective in dealing with these disasters. We've made good progress. For example, in Greece, we have a 112 emergency number, which we used very successfully to evacuate people and make sure that we save lots of lives. This is something, for example, that was not present in Maui. And when I look at the Maui disaster, it's so painful because we had gone through similar disasters 5 years ago, but we learned from them. And we are using technology in a much smarter way today to make sure that at least we can save people's lives.
The climate crisis is going to cost more money in terms of either dealing with events or also where you get your energy. Where are you going to get reliable, affordable energy from, and where do you get it?
Well, first of all, we get it from the wind and the sun. We are
affordable.
It is affordable. It is
reliable.
Cheaper. It is cheaper. It is reliable because we have lots of sun and lots of wind. But of course, it will not do the trick on its own. But Greece is one of the top 10 producers of renewable energy from the wind and the sun. We have 12 gigawatts of installed wind and sun energy in Greece, and much more to come. But of course, in the short to medium term, we will also need to rely on natural gas as a transition fuel. And there's a case to be made that Greece is playing a very important role in the European energy system because we are also an entry point for natural gas to serve not just the Eastern Europe, but even pumping gas up to Ukraine. So Greece's role as a pillar of geopolitical and energy stability in the Eastern Mediterranean has certainly been enhanced after Russia's invasion into Ukraine.
Prime Minister, one of the other effects of climate change could be that we face within Europe even greater pressure from migration. How destructive could that be to the forces that bind Europe, the EU, together right now? How damaging could it be to institutions such as the European Union? Could we see those institutions once again fraying at the edges because of the pressure that is being applied? And what do you think needs to happen now in order to try and avert that crisis? I know you've had talks with President Erdogan recently. Let's talk about how that could progress in terms of dealing with the issue. But how do you see the European Union doing more on this matter?
Well, obviously there are long-term solutions addressing the root causes of migration, but these are going to take time. As far as the short-term solutions, we need to do two things. We need to be ruthless in terms of breaking the smugglers' networks that benefit from desperate people who they put on boats which are clearly not seaworthy. But at the same time, we need to balance that by offering legal pathways to migration to those who can come to Europe and who can also help us with our economic growth. Look at Greece, for example. We're bringing our unemployment down. We already have labor shortages in sectors such as agriculture. So we want to do bilateral deals, but we want these people to come on our own terms and to come safely.
Prime Minister, we do have to leave it there. It was such a pleasure to catch up with you. Thank you so very much.
Thanks
Prime
for
Minister
having me.
of Greece joining us here. Thank you. Come back. The European close coming up next. This is Bloomberg.